Okay, so we're up to class 27, right before Thanksgiving here. We're going to start one of my favorite topics, if not my favorite topics in finance, which is derivatives and especially options. So just a little bit of background on what a derivative is. You see the word derive in there. So it's a security that derives its value from something else, from another security. It can come from a benchmark like the S&P 500 or some interest rate. It can be an exchange traded fund, a stock. It's almost unlimited right now what they've discovered they can do with derivatives on, even including weather. They have weather derivatives depending on how much it rains. There's just unlimited number of possibilities. There's only two types of derivatives. There's options and there's futures. Options include things like swaptions, which we won't talk about in this class, but a very interesting topic. Insurance itself, when you buy auto insurance, you're buying an option. We talked about this earlier in class. Your right to pay off your mortgage early is an option. So when you do your mortgage, you're paying the interest rate on the mortgage, but you're also paying an extra interest rate to cover for that option premium because you have an option on your mortgage. It gives you the right to pay it off early. So that tells you what an option is. An option gives you, as the buyer of the option, the right to buy or sell something in the future at a stated price. So we'll be talking specifically about stock options, but there's a lot more than just stock options. So why would that have any value? Why would you want to do that? So we'll figure it out as we look at some examples, because it's really a very powerful concept in finance that has applications beyond just option markets. There's a lot of other places that it applies. Futures, to me, are not quite as exciting. Futures include things like futures and swaps and forwards. I'm a big fan of swaps. My risk management class, we spend some time on swaps and how they work to manage risk. I love swaps. I'm not as big of a fan of futures. They just are not as easy to deal with, I think, as swaps are. Swaps are just a lot easier to structure. And in forwards and futures are essentially the same thing, except for just how liquid they are or how they're structured. But with forwards and futures and swaps, you're creating an obligation to do something. So that's the key. With an option, you have the right to do something, but you don't have to do it. If you buy the option, you have the right, but not the obligation to do something. With a future, once you enter that futures, you are now obligated to do something in the future. And the only way to get out of that obligation is to unwind the transaction, buy it back, whatever price it's at. So those are the two big groups. There are no other types of derivatives. They fall in those two categories. There is some terminology that you need to understand. Probably the most important one is what we call notional value. So notional amount, just like the word notional, it's not real. It's not an actual thing that you buy or sell. The notional amount is essentially the size of the transaction. It's the amount of money that determines how much gain or loss you're going to have. And is not the same as the market value. The market value of an option or a future is not its notional amount. The notional amount will tell you how much the gain or loss on your option or future is. It will give you an indication of that, but it's the basis, the underlying basis. So it's going to tell you how your derivative changes. So if you have a $100,000 future on oil, that's going to move 1/10 as much as having $1 million future on oil. The $100,000 or the $1 million, that's your notional amount. So for example, if you are long, if you buy $1 million S&P 500 futures, the $1 million is your notional amount, but the market value of that at execution is zero. When you first go into that future, your market value is zero. I remember the first time I did a swap. I did several interest rate swaps when I was at UTSA. My notional amount might be $3 billion, but my market value, when I put it on the books, it's zero. So when the accountants set it up, they hardly even have a transaction because there's no cash flow, there's no market value. So they've got to remember, I got this transaction when there is no cash traded hands. I just have this contract. But as that transaction changes in value, my market value will change, and that market value will be determined by the notional amount. The notional amount will tell you how much my gain or loss is. And so notional amount's kind of a tough concept, but it's truly amazing how much the notional amount is out there on the market. So this is a website one of our presenters in the Investment Society showed us, which I think is pretty interesting. It shows the value of everything in the world, market value, so silver, cryptocurrency, the U.S. deficit, coins, and the Federal Reserve balance sheet, the value of all the wealth owned by billionaires, gold, how much gold is in the world, the value of the Fortune 500. And you can see how some of these bigger companies are really starting to dominate the market. The size of stock markets, the size of the money supply, global debt is just huge. Global real estate is by far the largest. And then when you put all that together, global wealth, then you get down to derivatives. And here it gets incredibly interesting. So the market value of all derivatives is $11.6 trillion. Compare that to the stock market. If I can go back to the stock market. Stock market is about $90 trillion. That's all stocks in the world. About 20 trillion of that is the U.S. stock market. So when you get down to derivatives, their market value is $11 trillion, which is fairly significant. So it's probably half the size of the U.S. stock market, about a ninth of the size of all the stocks in the world. So it's a significant number, but it's not as large as the stock market. But look at the notional value. The notional value, this is the low end estimate because we really don't know. No one actually reports this. There was a lot of talk with the some of the reform bills from 2008 is that we need to start reporting these notional values. We need to know what they are. But these are over-the-counter transactions, a lot of them, so we don't actually know for sure what the true notional amount is. But look at that, $558 trillion. The U.S. economy is only, what, $25, $30 trillion. So the notional amount is a huge number, and this is the low end. Look how far down that goes. The notional amount at the high end is whatever 1,000 times a trillion is, a quadrillion. It just dwarfs everything else. So should we be worried about notional amount? Well, the press always like to quote notional amounts when they talk about derivatives because it's such a scary number. It dwarfs everything else. But the notional amount, first of all, it's a little deceiving because you don't know what the notional amount's applied to. So when I did an interest rate swap, my notional amount was applied to something related to interest rates. Well, if I did a $3 billion transaction with a duration of 5, that was the exact same thing as doing a $1.5 billion transaction with a duration of 10. And so my notional amount, I could move it around and have the exact same transaction, but just based on what duration I did. If you take my risk management class, we get into that and how notional amount and the duration have an influence. But there's also offsetting transactions here, both sides of the transaction. So there's a chance, I don't know how they calculated these numbers, but there's a good chance they're double counting this. Someone's long on an S&P 500 future of $1 billion, and someone's short on the S&P 500 future for $1 billion. Well, those two offset each other, and they just wash out. So very different than the stock market. If you're long and short on the stock, what we're showing for stocks is the net long position. So the short positions actually reduce it. But here, my guess is they probably have not reduced this for the offsetting transactions. But it's a huge number, and you can see how it just completely dwarfs the page. They can hardly even fit it on there. So there's a website to that if you want to write that down. It's an interesting website, very, very interesting to see how they actually calculated numbers would be interesting to see, and obviously it changes every single day. So that's the notional amount. Now, notional amount or notional value. What is the underlying? The underlying is what that notional amount applies to. It's the underlying asset, security, index, price, whatever you're looking at. It could be oil prices, it could be Apple stock, it could be the S&P 500, it could be Treasury securities, whatever that is. That's what the notional amount is applied to. So there's just a lot of them. Currencies is a big one. We talked about weather. UTSA was the first company to do a derivative-like security on catastrophes, hurricanes, and earthquakes. Life insurance companies are starting to do this. There's some social impact bonds that have some optionality to them that are very, very interesting. Finance has found a way to create transactions on just about any possible cash flow and any possible index. Very interesting stuff. There's also inflation is interesting. There's derivatives on inflation. They're not a very deep market, so it's hard to do transaction in them. We looked at them when I was at UTSA, but UTSA needed billions, and they just didn't have that kind of market size. So some things work better than others, just because you really need. In fact, there's a great book I read on the firms that create these new types of derivatives, and the gentleman who wrote it, had a long history and actually worked for some of these entities that created these new transactions. It was interesting just to read how they went through that process, when a market would work, when a market wouldn't work. They're creating these new transactions all the time, but some of them just don't work. And he said that to work, you need someone on both sides of the transaction that's worried about what's going to happen. So if you're worried about interest rates rising, you can do an interest rate swap. If you're worried about interest rates falling, you can do an interest rate swap. So there's people on both sides worried about rates rising and worried about rates falling. When I was working with UTSA's pension plan, I was worried about interest rates falling, and so I did a swap that would make us money when interest rates fell, and that did extremely well, especially in 2008. Right now, there's probably more people worried about interest rates rising, but for these transactions to work, you need a good balance on both sides, where you have people that are worried about the opposite side happening, or they want to get exposure to the opposite side happening, and so you have a good liquid market where you have players on both sides of the market. There's several really good resources. If you're interested in options, the CBOE is a really good source, the Chicago Board of Option Exchange. Their website is excellent. They have a lot of free type of educational material. They have an option pricing model that you can online put in and actual price the option. It's a really good website. I do recommend it. Khan Academy, you've probably heard of them and have used some of their material. They have some really good videos on both options and futures. I like his videos because they're short, they're to the point. He explains it really, really well. There's some books that are highly recommended. Options as a Strategic Investment is a good book. One book I do recommend a lot is this Trading on Corporate Earnings News. It's very much what you did for paper 2. It takes the reported earnings for companies and trying to do option trades right around that earnings reporting date. And this book goes through that. Not only does it talk about options, and it does a specific strategy we'll talk about, which is a straddle. It doesn't just talk about straddle strategies, but it also talks about corporate earnings reports and how that affects markets. So it's a very interesting book. It's not a very long book, and it's very easy to read. They left out the jargon, so I do recommend that book. The option guide, we might actually use a little bit of the option guide in this class. We'll see. They do a good job. There's podcasts. Here's a group of podcasts right here that are specifically about options. So there's plenty of places that you can go. You may not know if your career will be involved in options. My career used a lot of options, especially at the end. I loved options. Really saved UTSA in 2008. Both interest rate swaps and options for UTSA probably saved us a couple of $1 billion in 2008. It was really huge in keeping UTSA's net worth from actually falling. We actually had our net worth grew a little bit because of these derivatives that we used. So they're powerful things. They can be dangerous. So if you're interested in actually trading options and futures, I strongly recommend you start with a paper portfolio. Get used to the environment, because I know people who have really lost a lot of money, especially futures. With futures, you start off with a zero market value, so it doesn't look like you've done anything. But my word, if once that underlying starts moving, you're going to start seeing some pretty big gains and losses if you don't know what you're doing. So be careful. So let's start with futures. I'm up to page 49 in the notes. So again, it obligates you to do something. You can go long on something if you're bullish, you think its price is going up. You go short on something if you're bearish, you think the price is going to fall. We say long and short. Usually long means you're buying something and short means you're selling something. With futures, there's no cash flow up front, so you're not actually buying or selling anything. So you think of long and short as long if you're bullish, short if you're bearish. Bullish means you think the price is going up. Bearish, you think the price is going down. And this is true. Some people get confused on interest rate options. Interest rate futures. When you do an interest rate future, you're not bullish on interest rates going up. You're bullish on bond prices going up. And remember, bond prices and interest rates go in different directions. So when you're long on interest rate future, you're actually betting for interest rates to come down and bond prices to go up. If you're short on interest rate futures, you're actually betting that interest rates are going to rise, which means bond prices will fall. So you got to be really careful about that. So FinViz has a list of some really, really well-known futures. So if you go into FinViz and click on futures, you'll get to see some of the most popular ones. And I'm happy doing this. I'm doing this video on a day when the stock market is up quite a bit. It looks like we even have some record highs here. The Dow's getting close to 30,000. We'll see when you actually watch this video what happens. But we have futures that are based on stock markets. There's obviously a lot more than just this, but these are some of the most popular ones. We even have futures based on the VIX now, which is the Volatility Index. We'll talk about the VIX here a bit later when we talk about options. You then get into the commodities like energy. We obviously have futures on oil, natural gas, ethanol, on interest rates as well. So the 30-year bond, 10-year bond. And that's where I was talking about notional. If you do the 30-year bond, that's going to be a lot more volatile than the 5-year note. And so if your notional is $1 billion in a 30-year bond versus $1 billion in the 5-year note, that notional is not equal. The 30-year is far more volatile and it represents a much larger number. But there's interest rates, but other commodities. So we have stock markets and interest rates, other commodities. You have some of the agricultural goods. I like to watch the coffee prices because we do a lot of coffee loans in Costa Rica. Get into the metals, gold, obviously silver, platinum, copper, palladium. Into some more agriculture, soybeans, corn, wheat, rough rice, oats, canola. And then you get into the currencies. These are some of the currencies you can trade. Currencies is one of the largest derivatives out there because there's a lot of international trade going on, obviously. It's good to see that coffee's up a bunch today. And natural gas is down a bunch today. Who knows why? It's really interesting to me. Natural gas, boy, it's falling down, and boy, it's stayed down for the longest time because of all the fracking we're doing in Texas and other places where they're just finding so much more supply. So let's look at futures. We're not going to spend as much time with futures as we do for options, and the main reason is futures are simply another way of buying an asset. You can go out and buy oil. If you got room in your backyard, you want to buy 1,000 barrels of oil and stack them up, you can buy the oil itself. Or you can do futures on the oil. Or you can buy the S&P 500 itself by buying an index mutual fund. Or you can buy futures on the S&P 500. It's the same transaction. You can replicate it exactly. And so to me, it's not all that exciting. It's just another way to execute trades. Whereas options is something radically different and quite unique in finance that I think makes them a little more interesting and exciting. So let's look at oil. So with oil, as an example, oil has a spot price, which is what you could buy for today. And you can see I use $100 round. I know oil is much lower than that today, but I like using round numbers. It just makes it easier. So let's say the spot price is $100. Or you can enter a contract that requires you to buy oil for $102 in 3 months. Now, why in the world wouldn't you just buy the oil today for $100? Why would you spend more, $102 in 3 months, and why would you obligate yourself to do that? All right, so the $100 is a spot price, what you can pay today. The future price is at $102. Well, if you bought the oil today, 1,000 barrels of oil today, so you're out the cash, and now you got to store that oil. You don't need it for 3 months. So now you got to store it. And so you have two things going on here. You have the cost, the time value of money, because you have to pay for the oil today where you could have waited and paid for it in 3 months. And you also have the storage cost. So those two together is what we call cost of carry. So if we buy the oil today for $100, and we could sell the future contract today for $102, we made $2 in profit. Or did we? When we paid $100 for the oil today, we're out the $100. We got to spend $100 by 1,000 barrels. So we're out that amount of money. So $100,000 for 1,000 barrels. We sell the futures contract. There's no cash flow there, and we won't talk about margin much here. But there's some margin to put aside, but not necessarily cash flow. You don't have to send money to the broker. You're not buying anything. You're just committing yourself to selling oil for 102. You bought it for 100 today, and you have a contract now to sell it for 102. You don't get the 102 today. You'll get it in 3 months. So it is a sure profit of $2 if you had no expenses. But you have expenses. You have cost of carry. So let's say it costs you $1.50 to store each barrel of oil for 3 months. So you buy the oil day for $100. You spend another $1.50 to store it. And then in 3 months you get 102. So you only have 50 cents in profit. But then the next thing is buying the oil today, you're out the money today. You could have invested that money today for 3 months, and let's say you could have made 50 cents on that money, on that $100, if you had invested today and waited for 3 months to buy it. So that interest expense is also part of your cost of carry. So if you look at it, you buy the oil today, you spend $1.50 to store it, and you lose 50 cents because you didn't invest the money. And then in 3 months, you get $1.02 back. You've broken even. You didn't get anything out of it. So you make $2 on the futures transaction because you bought oil for 100 and sold it for 102, but it costs you $2 to store it and then time value money. So it's gained you nothing. And that's what this future price should be. The futures price should equal the spot price plus the cost of carry. And that is the normal relationship. That's what we call contango. Contango is when the futures price is above the spot price because of the cost of carry. So what if the futures price was 104? Well, you can buy the oil today for 100, and in 3 months you're guaranteed to get 104, but it only costs you $2 to store it in time value money. So then you would have a sure profit of $2. Now, what would happen if that was the case with every investor, where every investor would go out there and do what? Buy oil. And what would happen to the price of oil? Well, it's going to go up. And it's going to go up to what? Well, probably 102, right? Because if you hit 103, people won't do this transaction anymore. Because if you pay 103 and then you have $2 of carrying costs, then you'll lose $1. At 101, they'll keep doing it. And so some people, I hear them say, wow, the futures price is 102 and the spot price is 1. So people expect oil prices to go up, but that's not really true. They've also got to cover their cost of carry. And the other thing that's wrong with that, and this is really, really important, if everyone thinks oil prices are going to go up in 3 months, oil prices will go up today. They won't wait for 3 months. So that statement that everybody thinks, well, people think oil prices are going up because the future price is 102 versus the spot of 100. That doesn't make theoretical sense. Because if people expect something to go up in the future, then it goes up today because that's what supply and demand does. So that's probably the best way to think about futures. It is true futures don't always trade exactly like this, and there's been a lot of theories of why futures prices don't always cover cost of carry. And there's something called backwardization, and that's when the futures price is actually below the spot price. And that actually is not that uncommon with oil prices. I'm not a futures guy, so I can't tell you exactly what that is. In that case, what you'd like to do is sell the oil today for $100 at the spot price, and then have a contract where you can buy the oil back at 98. Well, if you have 1,000 barrels of oil, you could probably do that transaction. But if you don't own any oil, you're going to find it's really hard to short oil. If you don't, you can't sell oil you don't own. It's really hard with physical security, physical commodities. It's really tough to do that. And so even if the market's in backwardation, it's going to be hard for you to do a transaction. Some people might say maybe there's a way to do it with an oil ETF or something, but the oil ETF is actually reflecting the future prices anyway. That's how they get the exposure. So I just don't know if you have backwardization. I'm not sure there is a true arbitrage trade you could do that would help you in that transaction. But I mean, that'd be the thing to do. Sell the oil for $100 a day, and you're guaranteed to buy it back for 98 in 3 months. So you essentially get your $100 a day. You can invest it and make 50 cents. You don't have the storage costs, and since you got the $100, you invest it, you make the 50 cents, so you'll end up making $2.50. The $2 that you have to pay the $98 away in 3 months. Now, students ask about the delivery of these transactions. Yeah, if in 3 months, if you buy an oil future, you're going to have oil delivered to you. What most people do is they get out of these transactions the day before. They do it in the cash market, so there is no delivery. If you short this, if you sell the futures, then yeah, you've got to deliver the oil in 3 months. But what most people do is they buy it back the day before, do it in cash, so they don't have to worry about the actual physical delivery of these commodities. The futures market is very liquid, and as I talked before, it can replicate the spot market. It can replicate the cash market. So you know, if you need oil in 3 months, you can buy the oil today, or you can use the futures market and essentially lock in a price in 3 months. Your cash flow today is essentially zero. You have a margin requirement. I don't make a big deal of margin requirements. When I did derivatives at UTSA, it was really easy for me. I would just go to the lady running our bond portfolio. I just say, hey, I need $1 billion in collateral for this option, this derivative I'm doing. Do you have a bond you're pretty sure you're going to hold on to for 5 years or so? She's like, yeah, I got 15 billion of that. You know, tell me what you need. It didn't hurt her at all. It just, the bond was set aside that if for some reason we didn't pay off the derivative, they would have that as collateral. We were always going to pay off the derivatives, so we didn't have to worry about that. So it was easy for me. I was doing, my portfolio was only a few $1 billion. Her portfolio was 15 billion. So if I needed $1 billion or $2 billion in notional, that's pretty easy. Same thing on the pension plan. I had $3 billion, $4 billion in assets. The transactions I are doing only required a few $100 million. So it was very easy. If you're doing on this personal portfolio, you will have to have something to set aside as margin. They won't let you do this transaction without you having something there as protection for your broker in case this thing goes against you. And so you enter a transaction, now you own $20,000. They want to make sure that $20,000 there. So be careful of that. That is a requirement. So you select the notional amount you need. Maybe you need 1,000 barrels in 3 months. Your notional amount there is going to be your 1,000 barrels times the price. So the notional is 102. And that's going to essentially define your gain and loss. The market value is at zero at initiation. Even though you're putting aside the margin, that's not your market value. Your market value is zero when you execute this. If oil prices go to 110, then you can buy the oil for 102 in 3 months and immediately sell it for 110, and you'll make $8,000. The other alternative is you buy the oil today for $100. It costs you $2,000 to store it, so it costs you $102,000. Remember that $2,000 includes the time value money. If you sell it for 110, you end up with the exact same gain. So these markets should always be in balance. The theories about why backwardation works and why these markets get out of whack, you can read those articles and discussion. I know the futures market blew up this last summer when the futures market actually went negative. Really bizarre, just because there was these contracts to deliver oil and there was no place to store it. So people were actually paying for people to buy oil from them. It's essentially selling the oil for a negative price because they didn't have any place to store it, and no one else had any place to store it either. And so it was very bizarre. When those things happen, if you're paying attention, you probably could make some money if you knew what you were doing, but it'd be really dangerous if you didn't know what you were doing. And this to me explains why I think Futures are just replicating the cash market. What we did with the futures gives us the exact same result as what we would have done if we'd been in a cash market. So the futures market is simply another way to enter a cash market. The cash market is just normal markets. You buy a stock, you buy a barrel of oil, you buy a bond. So the end result should be the same if markets are efficient. But there are times when markets get a little bit out of whack. I know it gets a little more interesting when you're talking something like oranges. Buying oranges today and storing them for 3 months doesn't quite work. So there are some commodities that gets a little trickier. But still, cost of carry should be the most important thing to take into consideration. Now, there are things called forwards. Futures and forwards are essentially identical, except futures are standardized contracts that are on exchanges. So you're stuck with their maturity dates. You're stuck with the prices they offer, the transaction, the types of the sizes of the transactions, those kind of things. You have very little default risk with futures because you're backed usually by a organized large exchange, which is unlikely to go insolvent, or for our government to let the Chicago Board of Option Exchange go insolvent. They're well-established exchanges. They protect themselves with those margin calls to make sure they have enough cash to cover their book of business if something goes wrong. Forwards are very different, and swaps are a type of forward. These are over-the-counter transactions, which means they're between two sophisticated investors. They're very illiquid transactions, although the swaps I did seemed extremely liquid to me, and I didn't think they were that difficult to deal with. But they're not going to be as liquid as futures. They're transactions between two sophisticated buyers and between buyers and sellers that are very sophisticated, usually very large notional amounts. I think all the ones we did were over $1 billion. You tend to be larger transactions. You can negotiate the terms. In fact, with me, the reason I want to do a swap instead of a futures was because I could pick exactly what I wanted. My broker offered me a 30-year zero coupon interest rate swap, which was to me just wonderful because it just cut down on the workload on my counterparty bank, and it made my notional much larger because the duration was higher. I mean, it's just incredible stuff. So yeah, when I called them the first time I did interest rate swap, just talking to them through what choices did I have, what could I do, what would work best. Very, very, very flexible. It was just amazing. I would not have had that in the futures market. The problem with forwards and swaps is you pick up counterparty risk. In my risk management class, I talk about a special counterparty risk that we faced in 2008 that I thought was really, really interesting. But in this case, you're not dealing with organized exchange. You're dealing with another party like Lehman Brothers or Goldman Sachs or JP Morgan. And so in that case, if they have problems, then you could actually lose money because they have collateral there for you. But if the thing you have an investment in goes from $500 million to $800 million, and you only have collateral of $600 million, and they go and bust, you're not going to get that extra $200 million. So there is counterparty risk. I'll talk about counterparty risk in my risk management class. It's a very unique type of risk. Most future contracts, as I said, are settled in cash, not in the actual physical delivery. In fact, some futures contracts, like on the S&P 500, can only settle in cash. They're cash-only type of transactions. So essentially what you do is you just take the other side of the transaction, it closes out your position, and do that the day before expiration, and then nothing has to be delivered to you in large trucks or to wherever your storage facility is. All right, that's forwards, that's futures. I do love swaps, but I don't want to get into them in this class. I just find them to be a magical thing. But I do want to talk options. Boy, I love options. I got USA heavy in the options in 2008, and boy, it was a wonderful time for us to do them. It really protected us a lot. So again, an option is the right to buy, that's called a call, or the right to sell, that's called a put, something in the future at some expiration date at a stated price. We call that the strike price. So does the right to do something have any value? You're starting off, you're going to have to pay money to have this right to do something. Why would the right to do something have any value? And you have actually a really high probability of losing that entire amount that you invest. So why would anyone do that? Well, because you have a small probability of a humongous gain. Now, your insurance is a good example of this. Auto insurance. It's like buying a put on your car. And what it says is, okay, if my car gets totaled, I have the right to sell my car back to the insurance company for its cash value. So you have a car that has a cash value of $7,000. You total it, is now worth $0. You now have the right to sell that car back to your insurance company for $7,000. Right now, your car is probably worth more than that to you. And plus, your insurance contract has very specific rules about when you can execute your option. You can't just tell your insurance company you want the cash value on your car. You have to be in some kind of accident that's covered by the policy, but it's still very similar to a put option. So does that have any value? So the best way to do this is actually go out and look at actual options. So let's look at Apple. I've loaded Apple here on Yahoo Finance, and I'm going to click on options. See, Apple's having a good day today. Let's just say Apple's price is $120. I know it says 120.30. Let's say it's $120. And let's go out. We'll have to see how far out in the future we want to go. Let's go out to March. So $120. I'll just round it down. We're going to go out to March 2021. We start with calls. You can see the last price, which we're not going to be so interested in, the bid and ask. The bid, that's the price that you receive if you sell it. The ask is the price you have to pay if you buy it. And it's easy to know. If you know you're selling something, you're going to get the lower price. If you know if you're buying something, you have to pay the higher price. So it's really easy to remember the bid and ask. Here's a strike. We talked about the strike. The last price to me is not that important because it could be... To me, the last price is not that important because it could be hours old or even minutes old. And so we learned that at UTSA that you don't want to use the last price to price these things. You want to use the current bid ask. So we're going to come down. So we said Apple's trading for 120. And here's a contract to buy Apple for $140 in March 2021. So you have to ask the question, why in the world would someone enter into a contract for the right to buy Apple for $140 when you can buy it today for $120? It seems like something wrong, and yet here's the price, $3.05. Why in the world would you pay $3.05 just for the right to buy Apple at a price that it's well above where it's currently trading? Sorry, we get these pop-ups keep coming up over and over again. I don't know how to get that to stop. So 140 bucks, 305. Well, why would you do that? Well, a good example, a good way to think about this is, let's say Apple goes to 150 bucks. So next March, you look at Apple, it's 150 bucks. You pay $3.05. And you can buy Apple for $140, but it's worth $150. So you could go right out and execute your option, buy Apple for $140, turn right around and sell it for $150. You made $10, and you only had to invest $3.05 to do it. That's a huge return, right? You make $10, and then take out the $3.05. So you're going to make a pretty hefty return. There's $7 return gain off of a $3 investment. That's a 200% return. That's impressive, and that's why we're willing to pay for this. So what if Apple's only worth 100 bucks? Let's say it falls from 120 to 100 bucks. Well, if you bought Apple for 120, you just now lost $20. But if you bought an optional Apple for 305, the most you can lose is 305. So if Apple is trading for 130, you buy for 120, is trading for 130, you're up $10, you bought the stock, that's pretty good. If you bought the option, you would have lost $3.05 because if it's trading for 130, you're not going to execute the option and buy for 140. So there you lose 100% of your money. So there's a good chance you lose 100% of your money, But if Apple is trading for 150, 160, or whatever, you're going to make a fortune because you paid $305 for this option. But if the stock's trading for 160, you get to buy it for 140, sell it for 160, you made $20, you made a huge gain. We're going to talk about this. We're going to use a lot of examples to actually show you how different options work. Today we'll probably just get into put and call options. But yeah, we want to make sure we fully understand how these things actually work in practice. So having the right to do something is always a value. You know, why would you put an option on a house? Well, because you want to buy it, but you might find something better. So the fact that you can walk away and just let them keep the money is kind of nice. But if you get to buy the house, you discover that it's a really good deal, or maybe housing prices suddenly shoot up, and you discover you can buy this house at a really good price. You know, the options, having the right to do something is always a value. Now, an option on Apple to buy it for $4,000, yeah, it has a value, but that value is probably less than a penny. You know, that's an option you might give away for free because it's probably not worth much, but it's still some value there. I mean, it's a chance something radical could happen with Apple. So this gets us to what determines the value of an option, and we've come up with this kind of mnemonic, or not mnemonic, I guess. Well, maybe it is kind of a mnemonic to help remember these 6 things. We had some really bad ones at first, but finally the previous classes come up with Texas Video. TXSVID. So Texas Video. So let's start. Now the X might be a little confusing. Some of y'all might think it should be a K instead of an X. But the X is the strike price. All right, why X? Well, if you go bowling, in bowling, a strike is an X. I haven't been bowling in probably 20 years, but I bowled a lot when I was in high school. So bowling, a strike is an X. If you're more of a baseball person, then a strike is a K. So sometimes you'll see the strike price as an X. Sometimes you'll see it as a K. It probably depends on what sport you like more often. I think CBOE, I think they use X's, but I can't remember. But I've seen it both ways. If you go out to Wikipedia and look at option pricing models, you'll see it, I think, as a K in that model. We'll look at it and see. I'll show you the formula here in a second. So that's the strike price. So for a call option, the higher the strike price, the less valuable the option is. So think about with Apple. If I have Apple trading for $120, a strike price of $125 would be much more valuable to me than a strike price of $150, because Apple is much more likely to be above $125 than it is to be above $150. So for strike price, the higher the strike price, the less valuable is the call option. For the put option, since that's the right for me to sell it, the higher the strike price for put option makes the put more valuable. All right, we're going to see when we get to the current price, it's the exact opposite down here. The second thing, the T of Texas Videos, is time. So don't get confused. The S does not mean strike. The S relates to the underlying stock price. All right, so T is time. The maturity date, when does it mature? Usually the 3rd Saturday of each month, but there's a lot more options now. But the official ones, are the most liquid ones, are the 3rd Saturday of each month, but it's really the 3rd Friday, but they do it through Saturday, just give you all day Friday to get everything resolved. The more time an option has, doesn't matter if it's a call or a put, but the more time on an option, the longer the expiration date, the more valuable options are. Options have what's called time decay. So I'm gonna show you how to calculate time value. It's one of the questions on the exam, so I'll get into that. But time value is how much more you're paying for the option than its current intrinsic value, and we'll get into that. I'm going to show you the formula for intrinsic value, so it's not that difficult. About half the class got that question right on the final, so more and more students are getting it every year. It's a little tricky question, but it's not that bad. So time value is the difference in the options price and its intrinsic value. So we'll see that pretty quickly. I mean, just give you an example right now. That option on Apple stock for 140 strike when options trading for 120, the intrinsic value is 0. And the way we say that is you would not execute that option today. You would not buy Apple for 140 today under the option when you can buy for 120. So it's intrinsic value 0, which means the entire value of the premium is all time value. That $3.05, that's all 100% time value. So we'll see that. We'll look at that and see how that works in real life. So for call options, the intrinsic value is the maximum of you take the underlying price minus the strike and 0. So in our Apple example, you take 120, the underlying price, minus 140, the strike price. What's the max of that? Well, that's negative 20. What's the max of negative 20 and 0? Well, negative 20 is much lower than 0. 0 is the max. And so in that case, the intrinsic value there was 0. The intrinsic value cannot be negative. You're not going to execute an option if you don't have to. You just let the option premium expire, let the option expire worthless. So intrinsic value is 0 or higher. And we'll talk about in the money and out of the money. The S of Texas video is the underlying stock price. And you'll notice it does the exact opposite as the strike. Remember with the strike, higher strike, lower call, higher strike, higher put. With the underlying, the exact opposite. Think about Apple stock. You have the right to buy for 140. You executed the option when the stock was trading for 120. Now it's trading from 160. That call option is going to be much, much more valuable. The exact opposite on the put option. For a put option, the higher the underlying price, the less valuable the put option. Because with puts, it's the right to sell something at a price. Well, if you have the right to sell Apple for $100, and now its price is $150, and that's going to be a lot less valuable to you than when Apple was trading for $105. It's much more likely to fall below $100 when it's trading for $105 than if it's trading for $150. So the higher the underlying, the more valuable the call. The higher the underlying, the less valuable the put. So the call is a bearish strategy. It gains when the stock price goes up. The put is a bearish strategy. Its price falls when the underlying price falls. So its price falls when underlying stock price rises. Boy, sorry, I said that backwards. So the call price rises when the underlying price rises because it's bullish. A put price falls when the underlying price rises because it's bearish. All right, so we got the T, X, and S. Now let's get the last three. The V is maybe the most important one, and that's the volatility expected on the security during the time that you hold the option. It's not the past volatility, it's the future volatility. And everything in Texas video, the T, the X, the S, the I, and the D, we know all of those when we buy the option. The only thing we don't know when we buy the option is the volatility that's going to happen over the next 3 months. For both puts and calls, when volatility goes up, both puts and calls are more valuable. Higher volatility means higher price, higher value. This leads to that VIX we talked about, the Volatility Index. You saw that on the FinViz futures page. The VIX is that implied volatility in option prices. It's the one unknown. Everything else is known, so you plug in all the known, and then you find the volatility needed in order to get the current option price. VIX is one of those things I talked throughout the semester, things you can go look up on Wikipedia and Investopedia. The Volatility Index is a good one. It's really cool on my job. When I was running equities for USA's mutual funds, I had to present to the USA mutual fund board, and one of the board directors was a professor from Rice University, and she actually, as part of her dissertation, created the Volatility Index, the VIX that you see out there. And boy, it was so interesting talking to her. She sent me some files that I couldn't take with me because she sent them to me at USA, but it was really interesting. Some of the numbers she had, and she could go back quite lengthy way historically and show how they actually tested the VIX against actual volatility. Very, very interesting. So for options, more risk makes the call more valuable. More risk makes the put option more valuable. More valuable, why? Because with more volatility, the more likely your option is to have value. The more likely you are to be, so if you bought an option on Apple for $140, it's currently worth $120, but they get really volatile. that high volatility is more likely to kick you above 140 bucks than if there wasn't much volatility. Now this directly contradicts the capital asset pricing model. Remember the capital asset pricing model, more risk gives you a higher discount rate. You're doing this in papers 3 and 4. A higher risk, a higher beta gives you a higher discount rate, which is going to reduce the value of the stock. But with options, more risk, more volatility actually increases the value of the security. So options are a very unique part of finance. They give you a lot of insights, not just on options, but other parts of finance are much more understandable. We talked about the contingent claim analysis for valuing a stock. There are some firms that have these options that they could execute, and you actually can value those options very differently than you value a normal stock. So there are applications out there for option pricing theory that goes beyond just options. Right, the I for Texas video is interest rates. This one's a little tricky, but it gets back to what we talked about with futures. When you do the call option, you don't have to buy the stock today. You're essentially delaying it into the future. So you're saving the time value money by doing the option. With puts, you could sell the security today, but instead you do a put on it. So then you're losing the time value money. So high interest rates increase the value of the call option because instead of having to buy something today and have a higher time value money, you get to delay it to the future. And then higher interest rates decrease the value of the put because you sold it and you could have invested at a higher rate. So yeah, so puts are hurt by the time value, calls are helped by the time value of options. So I don't know how much interest rates are impacting call and put option prices today because interest rates are so ridiculously low, but they do have an impact. Dividends, it's the last one. Dividends, because as we saw earlier, when a stock pays a dividend, the stock price falls by the dividend amount. Obviously, that's good for put investors and it's bad for call investors. So the option price will take in consideration the expected impact of the dividends. But we can ignore that for right now. But if you go out to cboe.com and look at their option pricing models, they'll show you how to handle these different things. So if you go into Wikipedia and look at the Black-Scholes option pricing model, they'll give you the actual model. So here's the formula down here. Let's actually, here's the formula down here. The formula for a call, a formula for a put. I used to have this formula memorized for the CFA exam. I have to look it up now. I can't remember all the pieces of it. But so S is the value of the underlying. K, see here they use K, they don't use X. That's the strike price. R is interest rates. The sigma is volatility. T is time. And T minus T gives you how much time is left. So that's expiration date versus what date you're on today. So it has all those pieces. We don't have dividends in here because the original Black-Scholes did not adjust for dividends. But if you look at Texas video, there's the T, there's the X, it's a K for them, there's the S, there's the V, there's the I, they use an R for that. And then the dividends is not part of that. It's not that difficult a formula. I set this up at UTSA because we had officers coming in from other companies. And UTSA, because it's not a publicly traded company, could not provide stock options to their execs. And so when an exec came in from a public company and had options, I had to sit down and figure out, the value of those options because they weren't regular options. They had very specific values, valuation dates, and that kind of thing. And so I used Black-Scholes to adjust for that. So it's not a difficult formula. If you take the CFA exam, you may have to memorize this. The N is just using a normal distribution function. So you've seen that before. That's not all that difficult. And so you can easily put this in Excel. Might even have some of these functions already set up. It's not that difficult to set this up. It looks a little bit tedious of a formula, but it's not that difficult of a formula. Use the E function for discounting, but you've seen that in some of the classes. So it's a fairly straightforward formula. You can see some alternative formulas, but that's the Black-Scholes formula. So we use Greek letters to indicate different aspects of options. So delta, that tells us how much is the option that we're buying, the underlying option, how much does it change in price, giving the percentage change in the underlying. So if you have a delta of 60%, what it means is if the underlying goes up 10%, your option price will go up 6%. Gamma is a lot like, so if you think of delta and gamma, they're a lot like duration and convexity for bonds. So delta is that kind of point estimate for the change in one versus the other. Gamma is like the change in the change. How does a delta change as the underlying price changes? So it's a lot like convexity. Theta, it tells you the time decay is related to time. So it tells you how much the option price will change just because of the passage of time. Vega starts with a V, so it makes it easy. It's the symbol that tells you how much will the option price change given a change in volatility. And in rho is how much the price will change of the option given a change in interest rates. So these are good to know. They're kind of easy to remember, theta, vega, and rho, because you think of theta for time, vega for volatility, and R for rate, interest rates. And then all you have to remember is delta and gamma, and that's just related to the underlying. So an option can be in the money, out of the money, or at the money. So the option I showed you, the call option I showed you for Apple, if the strike price was 140 and Apple's trading for 120, that's out of the money because the current price was less than the strike price. If the current price was 140 and the strike was 120, the call would be in the money. But the one we looked at, the current price was less than the strike price, so that's out of the money. So if it's out of the money, it has no intrinsic value. If the current price is greater than the strike for a put, then it's out of the money. So if we did a put option on Apple, where Apple was trading for 120 and our strike was 100, that put would be out of the money. So the one we did was the strike was greater than the current price, that 140 versus 120, that's out of the money. If we had a strike price on Apple of 100 or 140 and the current price was 120, that would be in the money for the put option. I see if this is confusing at all, you don't need to worry about it because I'm going to actually give you a formula that sets all that up. If your strike price equals your current price, so right now with Apple, with them being right at 120, call options and put options at 120 would be right at the money. And so almost all of the value would be time value. But trust me, I'm going to show you a formula that shows you how to do this. All right, so what we want to do is value some of these. What we're going to do, we'll have to wait till next class, but we might get all of these done in next class. I'm going to do it in Excel, and then you'll get to practice it for the exam. We're going to practice, we're going to set up what it looks like to buy a call, what we call a long call option. We're going to look at what it looks like to buy a put, and then we'll start doing different combinations. And we'll see. Next class, we'll start looking at those combinations, and then I want to talk about put-call parity. That's something else you can look up in Wikipedia that's really fascinating. But here's the formula that you need to know. For a call option, the ending value, or the intrinsic value for a call option is the max of the price of the stock minus the strike and zero. So for Apple, remember the price was 120. We had a strike of 140. 120 minus 140, that's negative 20. The max of negative 20 and 0 is 0, so the intrinsic value of that option was 0. And then your gain is going to be that intrinsic value minus the price of the option. So the gain equals a max of S minus X, underlying stock, minus the strike, comma 0, minus the call premium. The put's almost exactly the same except we switch the X and the S. For a put, it's the max of the strike minus the underlying stock and 0 minus the put premium gives you the gain. The intrinsic value is just this first part. All right, the intrinsic value, so the gain on an option at expiration is going to be its intrinsic value minus the cost of the option. All right, so that's what we're going to be doing, and then we'll be doing some combinations. The combinations might be we buy and sell puts, we buy and sell calls, we buy calls, we buy puts, we buy calls and the underlying stocks, we buy puts and the underlying stock would have different strike prices, different maturities. And then we'll talk about put call parity and get into that. So next class, boy, exciting stuff. What I recommend for next class is just make a note, have Excel open, because I'm going to be doing all of this in Excel. So next class we'll be moving fast to learn all these and get you some practice on just the basics of how to use options. It's interesting, I have a video out there from previous semesters that I built just for this class, and that is the most commented on video. There's people around the world that keep commenting on how great, how helpful that video was, and I thought it was a fairly simple video, so I'm amazed. As simple as we're going to keep it, there's people out there that like, boy, that's exactly what I needed. So you'll see the strategies we're going to do: protected put, covered call, straddles, and collars. Those are the four I'm going to put on the exam. We're not going to do spreads. They're just a little too difficult to do.